Everybody likes an underdog. Everybody likes when a troubled company starts coming back, starts putting things together, starts outperforming, and presents real value to investors. Today, we're going to talk about one of those companies. A company that's had some serious question marks around it, that has had a brutal performance so far this year, but that has seen some massive changes over the last little while and is likely to see some much bigger price gains this year than the drop we saw going in. Today, we're talking about Cenovus Energy. Now, if you don't know this company, this is one of the best Canadian oil stocks to buy right now, because not only have they been hit extra hard from the major tariff-driven downpour in Canadian oil stocks, where we saw these things get cut in, maybe not half, but dramatically cut. But also, they're going to be one of the biggest beneficiaries from the much higher projected price of oil going into this year, and of course, from their own internal efficiencies that they've been starting to really operate. And so, Cenovus Energy looks like an absolute steal. Today, we're going to talk about some of the reasons why, some of the projections going forwards, and just why you should consider this stock if you're buying a Canadian oil company. Welcome to Golden Arch Investing. My name is Liam. On this channel, we love to talk about investing in Canada. If that interests you at all, please do like the video and subscribe to the channel. Now, like I said, we're going to be talking about Cenovus Energy today. And before we get into the analysis, I really want to give you guys a little bit of an overview. Now, if you've been following the channel, this is a pretty common name we talk about on here. And it's been here for a couple of reasons. One of the main reasons is that they have been absolutely controversial in the context of Canadian oil and gas stocks. You don't often get stocks that split the community. Most of the time, if you're interested in this space at all, you're probably aligned on a couple key stocks. Things like Canadian Natural Resources, CNQ, of course. That's been an incredibly popular stock. Imperial Oil has had a crazy year. They've been doing a really good job. Even some smaller players. We saw ARC really outperform. We've seen Peyto really outperform. And of course, Tourmaline is just sitting there waiting for LNG Canada to finally get that shipment, get that good news flowing. But Cenovus has split the community mainly because they are split into two general groups. The business has an upstream and a downstream. And that means they produce crude oil, they produce, oil products, and then of course they refine it. Now, this is far from a unique business model. There are lots of companies out there that are called integrated oil stocks. The biggest and best examples in Canada would be Suncor and Imperial, who are considered sort of the legacy majors in the space. They're integrated companies. They've got incredibly reliable cash flows. They really don't depend too much on one side or the other of the business. So they've kind of just been trucking along, providing a very healthy dividend for just about generations now. But Cenovus had some real problems with their downstream operation, their refining business. And a lot of investors were saying, hey man, you should sell this business. They don't know what they're doing. They're incredibly inefficient. They're wasting money. You're wasting money buying in. Now, we talked a little bit a while ago about this sort of divide and how maybe they were starting to turn things around. And that story is going to continue. But in part, thanks to this sort of divided opinion, during the tariff-induced, stock market decline, and during the rout of people out of oil stocks and out of Canadian stocks, we saw these guys drop by more than just about anyone else in the market. I've got a chart up here on the screen. Over the last year, they're down 23%. And if you look at the drop going from the middle of 2024, where you see them, this is July 2024, just under a year ago. You see them at $20 a share US on the US listing, dropping all the way to a low of just about $10 a share directly after the Liberation Day tariffs. That's, again, just about a 50% cut. You lost half your value in the stock in less than a year. But because of that, investors who were picking up shares right after the Liberation Day boom, investors who were looking at this company, paying attention and seeing how maybe these guys weren't going to be in as much trouble, maybe the market wasn't going to be in as much trouble, maybe Canadian oil specifically was going to be a little bit better positioned, have now just about made 50% on their money as the stock has climbed and climbed and climbed up to where it's at right now, 1483 as of the close on June 13th. And so the question now is, will we see these guys climb all the way back up that $20 a share mark. Is there still, $5, $6 a share worth of increase? Or are we looking at a local top and we're going to see these guys continue to trend down with the expected price of oil dropping all the way to 50 over the next little while? Well, let's talk about a little bit of analysis into specifically how I think Cenovus is going to do over the next little while and why I think they're still a great value play. Okay, we've got an article here from Mountain Valley Value Investments talking about Cenovus Energy, and they cover a couple key elements that I think present real value to investors. First, disciplined growth. One of the biggest things you need to see in this space, in a resource space like this, where there is huge potential, but there's also great ways to light money on fire. It's really easy in the Canadian oil space to burn through cash. Discipline is king. Then you have aggressive buybacks. This is part of the playbook that has been sort of advertised by guys like Eric Nuttall, one of the most outspoken Canadian oil and gas investors, of how to unlock value and real share price gains for investors in a space that has just about a capped growth potential. Now, of course, I'm a big believer that we are going to uncap this industry and we're going to see it grow dramatically over the next 5-10 years. But of course, that hasn't happened yet. And so if you want share price gains in the shorter term, the medium term, you need to see some other method of per share growth. One of the best ways, aggressive buybacks, using some of the cash flow to directly return that money back to shareholders. Of course, there is real value in the price of this stock. Price of publication here is $13.50, with the last price, of course, we talked about being in the 14s. So they published this just a little while ago, May 30th. So just about 2 weeks from my recording date, which is the 14th of June. And so, there's maybe a couple ratios they're going to mention in here that aren't accurate as of today or as of you watching this video, but they are accurate as of publication. Let's see the summary here. Cenovus Energy offers disciplined growth, low-cost operations, and rising shareholder returns through aggressive buybacks and a growing dividend. Production is set to grow by 40% per share. Again, huge, important thing to look at. Per share growth in this industry. Narrow Lake and West White Rose driving long-term output and cash flow. Cenovus trades at a discount to peers despite its production per share growth potential and share buybacks, making it a buy. And risks include a falling oil price, operational disruptions, and regulatory or trade policy changes that could raise costs. One of the disruptions, and they might get into this in the article, it depends. I'm not sure exactly what the landscape looked like on the 30th of May. But there have been serious wildfires up here in Canada. These guys are located just sort of not quite north Alberta, but in northern Alberta. And I can tell you firsthand experience, there's been a lot of wildfires up there. And it has had some big disruptions to projects that they and many of their peers are involved in, right? Either direct or indirect. And so there's going to be some shorter term disruptions that you might have seen in the news that have maybe played into share price, but you shouldn't look too much into that. That's part of the sort of risks of doing business in a resource industry in the Canadian West, in the Canadian wild. Almost expected at this point. It happens just about every summer. So just wanted to put that out there. I'm not 100% certain that's going to be in this article. And before I get comments, I wanted to say that, especially reading operational disruptions, that's pretty recent in our memories. Intro. With tariff uncertainty and declining oil prices, it has not been a great first half of the year for investors in Canadian oil. Amen, hey. However, the oil industry is a cyclical industry. It can be a good idea to take a step back and look at the longer term. I like this already. Cenovus Energy, which they're looking at the New York Stock Exchange listing, which is CVE, same as our TSX. So that's why I'm using US dollars for all the metrics here. Has, like its Canadian peers, faced challenges over the past year, with share price decline of over 34% in the past year. However, this integrated oil company has an improving operational base and clear long-term upside. With aggressive share buybacks and a solid project pipeline, this recent sell-off looks like a good entry point for investors seeking a long-term growth story. With major assets like Christina Lake continuing to deliver and several long-term growth projects set to come online in the coming year, Cenovus is set to see a boost in free cash flow generation. Combined with aggressive share buybacks, production per share is set to rise 40% from 2024 levels. With the management remaining disciplined regarding capital expenditure, I believe Cenovus is in a strong position. In this article, I want to explore Cenovus' latest earnings, its growth projects, and why I believe the current share price presents an attractive buying opportunity. And of course, you see a slightly shorter version of the chart we were looking at a moment ago. And by shorter, I mean it doesn't hit to today, right? So you see that same decline we watched, right? But they're cut off just 2 weeks ago, right? And it shows how there was quite a climb up out of the 2020 lows up to their peak at the start of the conflicts in Europe, of course. And then it's been sort of trading in a channel, like up and down in that 16 to 22, 23 range before the decline to today. Q1 earnings. Cenovus Energy recently released their results for the first quarter of 2025. We talked about these when they came out. Strong operational performance. Production averaged 818,900 barrels per day from upstream operations, which is a 2% increase from the same quarter last year. This near record production was driven by strong performance at Foster Creek, which increased output by 7,500 barrels per day compared to the previous quarter, and small gains at the Sunrise and Lloydminster assets. Whilst production fell slightly at Christina Lake, it has still remained a top asset for Cenovus with production of 237,800 barrels per day. Numbers are getting me today. Downstream, though, throughput also saw a small rise from 655,200 in Q1 2024, 665,400 in Q1 2025. So Canadian refining saw a record utilization of 104%, which is impressive, while US refining ran at 90%, which is not impressive, which represented an overall utilization rate of 92%, which, as we talked about when the quarter came out, not great. In contrast with their peers, was not perfect. Q2 is expected to be weaker with maintenance at the Toledo refinery, but this should bounce back in the later half of the year. With these near record production levels and refinery utilization came a boost in revenues, which reached $13.3 billion, up 17.7% from a year earlier. Net earnings, however, saw a decrease from a year earlier, reaching 859 million Canadian dollars against 1.17 billion last year. This translated to net earnings per share of 47 cents Canadian versus 62 cents a year earlier, which is not great. Again, a lot of that is from that US downstream business, right? Where you see here, the US downstream business flipped from a profit of almost 400 million to a loss of over 400 million. And again, that was the big divisive issue that so many investors were very, very divided on, where they were saying, hey, this sucks. What are they doing? How are they losing money on this asset? And of course, their upstream side of the business boosted sales and boosted profits to offset this. Overall, free funds flow for them came in at 983 million Canadian dollars. On the balance sheet side, there's significant weakening. Whilst cash and cash equivalents rose 368 million to reach 2.77 billion through the last year, long-term debt rose to 7.52 billion, with them having net debt of $5 billion. Above the firm's target of $4 billion, significantly above the firm's target. This rise was in part due to changes in working capital and the $595 million returned to shareholders in the quarter. This includes $62 million in share repurchases, $333 million in dividends, and $200 million redemption of Series 5 preferred shares. So you can see, as I tell the story here of the most recent quarter, as we talked about, you can see why maybe the shares weren't killing it. You can see there are stories here. Right, there's stories with their balance sheet looking weaker. There are stories with their downstream business looking weaker to drive share price lower. That makes sense. Whilst net debt remains above the $4 billion target, management stated the company was inclined to aggressively return capital via buybacks given trading levels. Basically saying, hey, we think our stock is undervalued. They actually think it's so undervalued that it's better for their shareholders to repurchase than it would be for them to pay down debts. So whatever value they think, whatever percent they think their shares are undervalued, has to be greater than the value they're paying or the percent they're paying in interest on that debt. Just logically, if you look at it from a perspective of, well, what is the best use of our capital? If they're saying the best use of their capital is to repurchase shares, then those shares have to be undervalued by a percentage that is equivalent, if not greater than, the interest they pay on that debt, which is something. They're saying they're thinking this company is significantly undervalued. Supporting the stance, companies continue to aggressively repurchase shares, 109 million common shares for 178 million Canadian dollars through May the 5th. So we have a whole another month of potential share repurchases that we can't see, right? We don't have any sort of insight into that from any earnings. And we noted this when the earnings came out, how that was really unique, that they mentioned every share they had purchased right up until the actual publication of that earnings report. So they didn't just say, hey, we bought this much in the quarter. They said we've continued to buy, and it was a significant increase in price that they had purchased from the end of Q1 through to the release of earnings. Although Cenovus remains above its net debt target, I am supportive of buybacks at the current price. Too often, commodity firms end up only repurchasing shares when the commodity price, earnings, and share price have reached a peak. So true. Very common in businesses like this, that you see them sort of buy high, sell low. So maybe they'll be buying up assets when the commodity cycle is just killing it. They'll be buying back shares when they're just flush with cash and need to burn it, basically. Again, we talk about this. Being disciplined, being a strong capital allocator is probably the number one skill in these Canadian resource companies. So when you see discipline, you should reward it. When you see people taking initiative, maybe not necessarily taking huge risks, but taking some risk and picking the right moments to do it, doing it in a smart way, in a way that genuinely benefits shareholders in a longer term mindset, you should reward that. And so, these guys making these choices is a good sign. By repurchasing shares while the commodity price and share price are lower, this gives greater shareholder value, 100%. While this might be risky for some firms, given the low break-even price of operations, should not negatively impact Cenovus' balance sheet. 2024 alone, they repurchased 2.6% of shares outstanding. In addition, the annual dividend was raised to 11% to 80 cents Canadian, with management confident the firm will remain cash flow positive at $45 WTI. This is largely due to the nature of the firm's operations, with over 75% of upstream production coming from oil sands. The extraction of oil sands is characterized by high upfront capital expenditures pre-production, but once up and running, decline rates are low with fixed operating costs. Cenovus' Christina Lake boasts operating costs of only $9 a barrel, Foster Creek at 10, and Sunrise at 18, far below other methods of extraction. Overall, Cenovus delivered a strong start to the year. Strong production and strong refining utilization points to improving results through 25. While the oil price is weaker, Cenovus is taking advantage of the dip in its share price with meaningful capital being returned to shareholders. Combined with growth projects advancing on schedule, Cenovus looks well positioned for a bright future. I agree with just about everything there. Again, we've already talked a little bit about those earnings in the past. We've talked about that here on the channel. But I like what I see. I do. I like what I see with Cenovus. I like what they're doing. So let's talk about some of the things that provide real value going forward. And one of them, growing production and returns. Cenovus is approaching the end of its current 5-year plan to expand production by 150,000 barrels per day, with several key projects nearing completion. These include both the traditional oil sands that make up the majority of Cenovus' production and offshore production, enabling Cenovus to boost both production and free cash flow growth. At the Narrow Lake tieback project, first oil is expected in Q3. 5 well pads have now been drilled with steam introduced into the first 2. This project is expected to add 30,000 per day and connect to the existing Christina Lake facility, leveraging its existing infrastructure and keeping costs low. Should this be successful, this will increase the potential for further expansion from the nearby Kirby West project, helping Cenovus grow production with lower initial capital costs and taking advantage of Christina Lake's low operating costs. So this is huge. They have a structural advantage here. You might even call this a moat, right? They own this asset. This asset is super valuable, and it connects to these other potential assets that they can expand and take advantage of that initial Christina Lake asset to make more valuable. In the offshore segment, West White Rose is nearing production off Atlantic Canada. Cenovus is prepared to tow the concrete gravity structure to the field. Construction now 90% complete. First oil is scheduled to be delivered by Q2 2026. Once fully online, production is set to 45,000 barrels per day of high-quality Brent with minimal incremental operating costs. Assuming a WTI price of 75, White West Rose is forecast to produce almost $1 billion in free cash flow in 2028. And that's just now. We've talked about these major nation-building projects, and people are probably sick of it by now. But hey, wouldn't it make sense to invest a little bit more into infrastructure to allow more offshore development in Atlantic Canada? Newfoundland's in. They're excited about this potential. There's refining assets already in New Brunswick. Wouldn't it make sense to have more production there? And obviously, Cenovus is already there with assets that are expected to produce $1 billion in free cash flow. which when you look at the kind of numbers they were free cash flowing, they free cash flowed total as a business under $1 billion this last quarter. So if this asset free cash flows $1 billion, that could, that's a 25% quarterly free cash flow boost if things stay the same. And of course we expect them to grow, but still major asset coming online. Looking at the bigger picture, they're currently guiding for 2025 upstream production of 805 to 845 barrels per day, 1,000 barrels per day, around a 3% growth from the previous year. As both Narrow Lake Tieback Project and West White Rose, I'm going to do that backwards every time, come online, production is set to reach 950,000 barrels per day by the end of 2027. So you look at their growth, they're comparing themselves. This is from their corporate presentation in May. But look, they're looking at their production per share growth. Big important thing to note there, per share growth of almost 50% in contrast with their peers. And this is what happens when you combine that share buyback program with their production growth. And look, the next line, is set to see Cenovus boost production per share by 40% higher than any of its Canadian peers. With the majority of capital investment spending expected to be complete in 2025, capital spending is set to fall sharply, boosting cash flow, which can be put towards further shareholder returns. So they've made all these investments. These investments have to happen once you started allocating the capital. It doesn't make sense to just cut back on this. You can cut back on future projects, but these projects were scheduled years ago. The money's been being put in for years. And so you have to continue these projects even in the current macro environment, which of course is more bearish, sort of more counter or contrary to investment. It's sort of been, there's fear, there's uncertainty, there's all these different policies, there's all these different conflicts. It makes it harder to invest. But all of these investments are going to go on anyways. All these investments have to happen. You've already spent all the money. If you stop now, you just don't get anything out of it. So you're not going to do that. So they're going to continue completing these projects. But once they're done, all that money that you've been spending, now it goes straight back to shareholders if you don't have a next project lined up. With 8.5 billion barrels of reserves and a 29-year reserve life index, Cenovus is set for a bright future. As these low operating cost projects come online, production will increase while capital expenditures decrease, enabling them to enhance shareholder returns. Valuation. Such an important topic in conversations like this. It's almost impossible to talk about an oil stock without talking about their valuation. And when you're talking about their valuation, it can be hard to compare apples to apples. And so they're going to compare this to a bunch of different companies, but I want to point out that it can be hard to compare, the multiples of these companies. It can be hard to compare them head to head. I see people sometimes say, hey, you like this company and you like this company. What's up with that? Why don't you just pick one? Or why, what is the difference? Which one's better? And it's so hard to compare these big oil stocks because each of them does something differently. And I think Cenovus's biggest opportunity or their biggest selling point is the valuation. Compared to their peers, they are significantly undervalued. And we're going to, this author does a really good job of digging into that, but I just want that to be out there, that this is one of the main reasons we talk about this stock on the channel. Not necessarily that their assets are better or that their management is better or anything like that, but their valuation is killing the competition. Let's talk about it. Like most oil producers, Cenovus Energy's earnings are heavily dependent on the price of oil. Therefore, placing an exact value on Cenovus can be difficult. As such, I believe one way to value the company is comparison to its Canadian peers, such as, these are good ones, Suncor and Imperial. Remember, integrated, upstream and downstream. Then we also got Canadian Natural Resources, so maybe a little bit different, and Meg Energy, which obviously has gained a lot in valuation. All its peers share similarities in being Canadian oil firms with significant oil sands operations. True. Simple comparison of earnings multiples will not suffice given the vast difference in cash and debt levels. Therefore, use enterprise value to EBITDA to compare along with other metrics. Lots of different ways to compare. This is a very valid way. I've heard people say, hey, stop telling us PE ratios, right? Stop saying that on the channel. And one of the main reasons I do that is because it's kind of more user friendly. It's a lot easier to understand for most of us who aren't sector specific investors. Oh, okay, I get what a PE ratio is. That makes sense to me. I know the difference between sort of backwards looking and forwards looking PE ratios. I get that metric. It's a pretty universally used metric for all these businesses. But this is definitely a more accurate reading of valuation in an industry like this. And as you see very clearly from the chart that's been on the screen here, Cenovus Energy is very clearly the cheapest on the list by a significant margin. Some things I will say, Canadian Natural and MEG don't quite have the same up and downstream assets that Cenovus does. I'm not saying that they don't own anything. I'm just saying it's not quite the same sort of split in their business. And so it's harder to compare. Suncor and Imperial each have their own thing going for them. Obviously, Suncor and Cenovus are pretty tight. You could probably compare them a little more closely to each other. Imperial has had a lot of sort of investor excitement about that company. It's been really, really killing it. And so it's been given a premium valuation. So that's part of why those other ones are a little bit overvalued on this list. But hey, I mean, look, if you want to be buying one right now and all else being equal, you would buy Cenovus. Just like plain and simple. When compared to its peers, we see they traded an EV to EBITDA multiple of 4.57, significant discount to the average at 5.43. Also below the oil sector average of 6.27, despite the strong production growth of Cenovus and its lower operating costs. Look at other metrics, they continue to perform strongly with the lowest price to free cash flow at 4.46. That's cheap. While Cenovus' debt to equity ratio might be slightly above the peer group average, remember they have quite a lot of debt, still within a healthy range and partially due to the current focus on shareholder returns as opposed to debt reduction, which again we talked about. They have the lowest return on equity cycle of the group, but this may be due to the current ongoing capital investments. So you look at some of these metrics. So the first one there, price to free cash flow. It's the forward price to free cash flow. It's based on projection. But obviously, again, and even more so in this case, significantly cheaper. Significantly cheaper than Suncor, significantly cheaper than Imperial, Canadian Natural, or MEG. Return on equity, different. And you see part of why those other companies are valued, right? It's almost a, maybe not quite, but just about a direct comparison. So you see, right, obviously the highest return on equity is Imperial. Guess who has the highest price to free cash flow? Next highest is Canadian Natural. Guess who has the next highest, right? Suncor and MEG, just about the same. Obviously the ratio isn't going to be quite the same for all of them, but you see that the return on equity almost directly correlates to the price to free cash flow. Debt to equity ratio is a little bit different. Canadian Natural has a slightly higher one, but they've made all these huge acquisitions recently. That makes sense. Cenovus also has quite a high one, but we talked about this. They've been trying to get all these capital investments going, all these projects. They cost a lot of money, especially think about like offshore oil sands. The amount of money up front for those projects is huge. And we don't see a lot of those in the Canadian energy sector, obviously. So some of the peers don't have the same kind of things. But, Suncor is just about in there. Imperial has quite little debt, part of why they're so richly valued. And of course, MEG has sort of middle of the road. When we consider beyond the Canadian peers and compare to the integrated oil majors like Exxon, Chevron, and Marathon, the difference in valuation is striking. Those companies have significantly higher EV to EBITDA and price to cash flow, not free multiples, averaging 7.28 on the EV to EBITDA, which contrasts, if we go back up, Cenovus is at 4.57 and 7.74, which contrasts to Cenovus on I keep saying free, price to cash flow ratio of 4.46. And they have similar exposure to oil price, higher operating costs compared to oil sands, and in some cases, lower growth potential, partially because of the law of big numbers. Once you're the major, once you have a huge amount, how much more can you really own? Even if their valuation gap to US peers does not close, its lower multiples mean that Cenovus benefits from higher free cash flow yield and earnings yield. This means they have the potential to deliver stronger per share returns over time through dividends and buybacks, even if trading multiples remain unchanged. This is the big part of the overall investment thesis of owning a Canadian oil stock at all. Particularly if you're a Canadian investor like I am. You can hold these in a tax-free account, get paid cash every quarter, and you're getting returns through buybacks and exposure to the upside potential of this very cyclical industry at a time when investment into it is looking to expand. Huge, huge potential there. While there are near-term headwinds from a lower oil price, obviously, Cenovus Energy shares look like a buy. With low operating costs, growing production, and continued shareholder returns, the company looks like it's in a strong position. When you combine this with the fact that Cenovus trades at a discount, not just to its American, but also Canadian peers, Cenovus offers a compelling opportunity that looks set to outperform. For these reasons, I assign Cenovus a buy rating. As with any investment, investing in Cenovus is not without its risk. Primary risk is, of course, the dependence on revenues and earnings in the price of oil. This is largely out of Cenovus' control, with OPEC decisions, global economic conditions, and shifts in demand all impacting oil price. Weakness in the oil price will reduce free cash flow and potentially force them to reduce shareholder returns. though I anticipate Cenovus to remain free cash flow positive given the low operating costs of its operations unless the oil price falls significantly. Other risks also include the impact of operational disruptions, whether from environmental conditions or oil spills, and the impacts of new regulations, tax changes, and of course, Canada's trade relationship with the US that might push up costs. So to conclude, while the refinery assets faced weakness in the first quarter, Cenovus still delivered a strong set of upstream results, continued to return capital to shareholders. The annual dividend had been raised to 80 cents a share, and in the month following the end of the first quarter, they repurchased 178 million worth of shares. With growth projects like Narrow Lake and West White Rose nearing completion, these low operating cost projects will boost production and free cash flow. This positions the company to continue increasing shareholder returns through dividends and aggressive buybacks. With 40% projected production per share growth, strong reserves, and strong shareholder returns, Cenovus is a top performer among its Canadian peers. The current share price, I believe Cenovus Energy is undervalued and assign a buy rating. So let me give some of my final thoughts on the company. Right now, from a valuation perspective, this looks like the best Canadian oil stock to buy in Canada. Just flat out. When you think about the relative risks, the relative sizing, where exactly they sit in the business, and how their stock has responded to macro events, I think these guys are probably the name to buy if you're looking to buy something right now and you want returns in the next little while from valuations or multiples specifically starting to sort of get back to the mean, revert to the mean and climb back up. I think this trade has already started, and I think we're probably a few weeks into what will be a 6-month long trend. However, I think there is actually even more positive potential for Cenovus over the short term. Because recently we've seen massive escalations in conflict in the Middle East. We've seen massive escalations in conflict in sort of the Europe, Russia, through Eurasia region. And we've seen a bit of economic warfare focusing on the oil industry that could dramatically shift the calculus for the price of oil. We've seen that happen already with oil climbing into the 70s. WTI crude is in the mid 70s as I record this video. Just a few weeks ago, we were touching 50 something. So with that being said, it is totally possible we see another 2022-like event that spikes up the price of oil and spikes the price of this stock. If you see that happen, let me be incredibly clear here. If you get 20, 30, 40, 50% gains in a short period of time due to some sort of geopolitical disaster, you should treat it the same way we talked about treating Liberation Day a month or two ago. Take it as a massive event and make sure that the decisions you make fit your long-term thesis. I think this is an absolute buy right now. I think it's the most undervalued major Canadian oil stock out there, and I think you should probably own it if you want to own a Canadian oil stock for the next year or two. But if it goes up 20, 30, 40, 50%, please take some dang profit. Please don't put yourself in a position where you're holding thinking that this thing is just going to climb like that forever, because we see that every commodity cycle. Right? We talked about what happens when the companies buy into their own shares at peaks and how that can be negative, how they acquire assets when those assets are at their most valuable. Don't be that person. Don't buy high. So if you see a massive spike short term due to all this uncertainty in the world, maybe that's the time to sell a little bit and look to other undervalued areas the same way we did a month ago when we found Cenovus and we started buying in. That's about all I have for you folks today. Again, I think this is a great undervalued opportunity. I think Canadian oil in general has some huge catalysts coming, and I'm excited to see, in the next couple of weeks, if we see some big news stories come out of the talks that have been going on. Obviously, we have the G7 coming up this week. If anything major breaks, I will be talking about it. We have massive conflict going on. If there's some sort of major story regarding maybe the oil trade specifically is what I'm thinking. Again, I will make sure to bring it up here on the channel. And in general, if you've got a stock you want me to talk about, anything Canadian or anything Canadian investors are interested in, let me know, because that's what we do. We love talking about oil stocks on this channel. And with all that being said, I hope I see you in the next one.